Good morning, ma'am, and good morning, classmates. We are here to present the factors affecting financial statement presentation due to the COVID-19 pandemic when it comes to a small business. So, without further ado, let's get started.
So for our introduction, here's a background of the COVID-19 pandemic. COVID-19 started in 2019, but it was in 2020 that this virus spread quickly all over the world, causing the economy of every country to crash. To help prevent COVID-19 from spreading, a complete lockdown was imposed in every country. This lockdown caused a number of companies to shut down as well. As a result of this virus, investors and other stakeholders will certainly need high-quality financial information for which in an undetermined period of time will have a direct impact on many companies across the globe. It is vital that the company provide its shareholders and other consumers of financial information with appropriate and accurate information.
So let's now discuss the background of small businesses. The term small business is characterized as a private company, partnership, or sole proprietorship with fewer employees and less annual revenue than a company or a regular-sized company. The role of MSME, or also known as micro, small, and medium enterprises, in developing the Philippine economy is very critical. They encourage local economies, keep capital close to home, and sustain communities. Among the main advantages of small companies are versatility, typically lean staffing, and the opportunity to establish strong relationships with clients. Compared to large companies, since they have more versatile output options, they respond to shifts in demand in a short time and rapidly meet maximum competition conditions. Thus, they contribute to national revenue, welfare, competitiveness, and the training of entrepreneurs. So let's move on to the next topic.
Here are the factors affected in the financial statement presentation of a small business. Going concern. Management must determine whether these activities or circumstances, separately or jointly, throw serious doubt on the business potential to survive as a going concern, or in extreme situations, whether the going concern presumption is still sufficient as a jurisdiction in preparing financial statements. Some consideration includes: first, it has enough cash on hand and unused credit lines or borrowing facilities to satisfy immediate needs. Second, management must take additional steps to ensure that the business generates adequate cash flow to fulfill its commitment as they become due. Third, to seek financial assistance from lenders or government-sponsored programs to assist the business. Fourth, it needs to negotiate with lenders to restructure or expand credit facilities with lenders. Fifth, to reorganize activities in order to lower operating expenses. And sixth, to defer capital expenditure. Disclosure of the following is needed. First, data of events or circumstances that may hinder the business capacity to sustain as a going concern, as well as the management's estimation of their importance in comparison to going concern assessment. Second, significant judgment taken by the management in determining if there are material uncertainties in the going concern evaluation. Third, management preparation to lessen the impact of certain event or circumstances. And last, an explicit declaration that there is a material uncertainty about the entity's capacity to remain as a going concern, and thus that it will be unable to realize its asset and discharge its liabilities in the ordinary course of operation. Management will need to do the following when evaluating a company's ability to continue as a going concern. First, update forecast and sensitivity level as required, taking into account the known risk factors and various potential outcomes. It is essential to state about the worst-case situations, such as additional lockdowns imposed by the government. Second, Examine its preparation to deal with events or circumstances that could hinder the business potential to survive as a going concern. Management will be required to reassess the availability of funds in particular. The corporation must determine whether or not its plans are feasible and practical. Third, consider relevant regulatory guidance. Fourth, provide transparent and comprehensive disclosures, including disclosures regarding uncertainties found during the going concern evaluation. Last, examine the expected policy enforcement in various scenarios. Trade and other debtors, lessor receivables, and related party receivables. IFRS 9 allows the use of practical expedients when measuring expected credit losses under the simplified approach. For instance, using a provision matrix which may be applying segmentation to capture the significantly different historical credit loss experience for different customer segments. However, may no longer be appropriate and may need to be revisited to reflect the different ways and in which the COVID-19 outbreak affect different types of customers. The COVID-19 outbreak may result in a major increase in trade receivable loss rates. As a result, small businesses will need to consider how outstanding trade receivables can affect the timing and amount of cash flows produced and increase loss rates as necessary. According to the insights of IFRS, when measuring ECLs for trade receivables, assess how to incorporate forward-looking information about the impacts of COVID-19 outbreak. Consider whether the segmentation applied to measure ECLs appropriately captures the different type of customers or regions that are affected in different ways by the economic effects of COVID-19 outbreak. Assess whether a trade receivable has been modified, and if so, whether it continues to be appropriate to use discount rate of 0, and consider how to incorporate the impact of any credit insurance and government support. Next is contract assets. Due to the COVID-19 outbreak, many small businesses are forced to close their operation. As a result, existing contracts could become loss-making, which requires provisions. In line with this, small businesses may encounter struggles in fulfilling legal obligations such as delays or non-performance subject to penalties. The provision is applicable only for an existing present obligation. Management should consider whether COVID-19 has triggered a liability that could result in an outflow of resources. Examine the termination clauses of important acquisition of sales contracts to see if the cost of existing contract is less than the cost of fulfilling it. Perform the impairment test first before recognizing a provision for an onerous contract, and provide clear and meaningful disclosure about judgments and estimates made in recognizing and measuring provisions. Next is inventory. Inventory must be measured at the lower of cost or net realizable value. COVID-19 pandemic affects how small businesses manage their profit during this time because at some point, they sell their inventory items below the cost they incurred. Wherein they experience losses, they aim to dispose all of their stocks quickly before the government-imposed lockdown. Entities will need to monitor the sales price, values, and inventory turnover in demands subsequent to the reporting date and make adjustment to the carrying amount of inventory at the reporting date if necessary. Next is the property, plant and equipment, intangibles, goodwill, lease right of use asset, and cash generating units. COVID-19 can have significant impact on some types of investment properties such as retail and industrial properties. Tenants who have been forced to stop operation will be unable to pay rent in the immediate future or may request a lower rent to be negotiated and can also lose their credit worthiness. Companies would need to determine whether COVID-19's effect has resulted in an asset impairment. The economic consequences are likely to prompt an impairment test for long-lived asset and other asset classes in most businesses. Direct and indirect effects are expected to have a substantial effect on potential cash flow and earning estimates. Deferred tax liabilities may be reduced as a result of asset impairment, and additional deductibles may be created. Continuous identification, assessment, and reevaluation are needed to determine the scope of need for recognition and for what periods. Next is insurance receivables. Insurance proceeds to settle a provision are accounted for as reimbursement under IAS 37 provisions, contingent liabilities and contingent assets, and are recognized as separate asset when recovery is virtually certain. The amount recognized as a reimbursement right is limited to the amount of the related provisions. Management should first, review insurance policy and, if applicable, seek legal advice to assess eligibility to file and claim for damages incurred by the COVID-19 pandemic under insurance contracts. Second, assess if any business disruption caused asset damage, and if so, perform an impairment test. Third, only record a reimbursement for a provision as to separate asset if organization is almost likely to obtain it. And last, recognize receivable only if the right to claim compensation for business interruption is unconditional. Next is variable consideration. Under IFRS 15, revenue from contracts with customers, determining and timing an amount of revenue to be recognized often requires a company to make estimates and judgments. The COVID-19 corona outbreak has disrupted many industries and created uncertainties that may affect these estimates significantly. Under IFRS 15, if a contract includes variable consideration, then a company estimates the amount of consideration to which it will be entitled. Variable consideration includes discounts, rebates, refunds, credits, price concession, incentive, performance bonuses, penalties, and other similar items. It may be explicit or implicit. Companies must carefully consider what measures taken in response to the COVID-19 outbreak result in additional variable consideration. For example, customer discount or compromises. Furthermore, if a company's supply chain or workforce is interrupted to the point that it is unable to meet its commitments, fines can be imposed, reducing the transaction price. Actions for management to take now are: first, examine if the contracts involves variable considerations. Second, update estimates of variable consideration including the constraints. Third, assess whether estimated standalone selling price need to be updated. Fourth, when revenue is recognized over time using an output method, evaluate whether the progress toward satisfaction reflects the latest expected total inputs. Last, disclose information about the method's inputs and assumptions used estimating consideration and standalone selling price. Next is lease renewal and termination options and lease modification. Renewal and termination clauses in lease contracts can need to be reevaluated to decide if the lease term has changed. Any adjustment in the contract term may have a direct effect on the lease asset and liability carrying amounts. IFRS 16 leases requires a lessee to determine whether it is reasonably certain for first, to exercise an option to extend the term of lease. Second, to exercise an option to purchase the underlying asset at the end of the lease. Or third, not to exercise an option to terminate the lease early. Actions for management to take now is: first, consider whether COVID-19 related events and circumstances have triggered a requirement to reassess renewal, termination, or purchase option. Second, consider the impact of any changes in economic incentives or whether a company is reasonably certain to exercise or not to exercise such option. Third, provide clear and meaningful disclosure about judgment and estimates made in reassessing lease option and lease terms. Government assistance that meets the definition of government grants is accounted for under the specific requirements of IAS 20 accounting for government grants and disclosure of government assistance. Governments all over the world are reacting to the COVID-19 coronavirus outbreak by enacting a slew policy to support businesses and boost the economy. Identifying government grants, IFRS standards includes accounting requirements especially for government assistance in form of a government grant. Therefore, companies need to consider the distinction between government grants and other forms of assistance carefully. Actions for management to take now are: first, monitor government action and legislation to identify all assistance that may meet the definition of government grant. Second, develop accounting policies and procedures for government grants. Third, consider expanding disclosure on the accounting policies for government grants and the impact of grants and other assistance on the financial statements.
The COVID-19 pandemic has a great impact on small business financial reporting in the presentation area. First, we may notice the effect on current asset. As we all know, current asset are assets to be converted to cash or realized within a year. But due to the ongoing COVID-19 pandemic, many of these assets cannot be realized on current year. COVID-19 coronavirus outbreak may cause breaches of debt covenant. Liabilities no longer be able to be deferred unconditionally for 12 months or more. Breaches could cause debt to be classified as current liability. On the current asset held for sale, the effect of COVID-19 pandemic caused the management to sell those assets and look for potential buyers. The COVID-19 caused some small businesses to reduce their operation or cease the operation due to the losses that occur on the lockdown. Where this meet the definition of a discontinued operation, they will require separate, specific presentation and disclosure in entity balance sheet and profit and loss statement. In the disclosure area, IFRS 7 requires entities to full, transparent, and entity-specific, quantitative and qualitative disclosures regarding the nature and extent of risk arising from financial instrument. The COVID-19 environment will have wide-ranging but entity-specific impact to a small business credit risk, liquidity risk, and market risk exposure. Small business will need to revisit their financial risk management notes and update this so as to include consequential impact of COVID-19. Due to the uncertainty of the economic impact of COVID-19, there would be a significant changes in the assumptions used to measure fair value of the asset and liabilities of a small business at the end of the reporting period, including considerable change in valuation technique being adopted on account of changes of the market condition. Inappropriate disclosure to address the changes would become necessary.
Based on the previous details of our study, we concluded that businesses may be able to determine the impacts of COVID-19. However, they found that this affects almost all the line items. Therefore, it is more appropriate to disclose on the notes. In other cases of COVID-19 impacts might be unavoidable to the extent that organization can't decide the general effects. In this condition, we accept that the organization ought not to present the income statement and consider disclosing them in the notes, providing a quantitative whenever the situation allows and a qualitative information and expressing whether it has recognized only some or all of the effects. Industries find it extremely difficult to stay in businesses if the crisis lasts longer, are reduced in expenses in light of lower revenues, Yet, this deficiency of monetary action has a downstream impact. This indicates that the importance of well-designed and sustained economic and public health policy measures. Next slide. Although the economic status shows a widespread of reopening of small businesses, it keeps on demonstrating an enormous decline in business activity over a short period of time, especially on businesses which sells a non-necessity products. Management should also consider if the company can determine income and expenses that relate to COVID-19, and consider how the presentation of determinable impacts would fit into the current structure of the income statement, in determining the nature and extent of information to be given inside and outside the financial statements, which would reflect and affect the company's financial performance, which should be shown in the income statement.
Audio Jungle.